Hi there, this is Alvin from Dr. Wealth. It is earnings season and we have more companies reporting their results, and we just have one fresh out of the oven. That is a Mapletree Pan Asia Commercial Trust, or MPACT in short. They reported their half-yearly results, and especially the second quarter results are in focus here, and they're not great. And therefore, the share price have actually gone down 6% for a REIT, especially considered a blue chip REIT. It's something that will catch a lot of investors' attention, and people will be scratching their head, why is this happening? And I'm supposed to explain to you in this video what's going on for MPACT, and actually there are more implications to other REITs as well, right? So let's go on to their results for the second quarter of their FY. And one of the glaring things that you straight away can see in their presentation deck is that their revenue has dropped by 6%, and the net property income has dropped by 8.5%. So these are, although like not end of the world kind of numbers, for a REIT, you're supposed to be a lot more stable. So these numbers are still quite glaring, and raise some concerns whether this trend is going to continue. So let's break down what is going on. Okay, so there are some things that happen. So first is that they sold off the property, the Anson in Singapore. So that is an office building that was finally sold off, and that actually helped to relieve some of the financing charges. Okay, so you reduce the debt, and then the financing that you need to pay will go down, right? So that is all good, but that also means that the contribution to the rental income will drop. That's why the revenue drop. Okay, so and so forth. And there are again other consideration, like the foreign properties are not contributing as much rental as before, and also there were forex headwinds. That means due to the strong Sing dollar, some of the overseas currency like the yen has depreciated against Sing, and therefore the amount of rental income that's converted to Sing will reduce as a result. So that is one of the key challenges this MPACT has faced, and therefore all this contributed to the drop in the income. And they also reported that if they don't consider these forex losses, the net property income will still drop by 7.9%, right? The revenue dropped by 5.4%. So this again, even if we take away the forex consideration, it is still a decline in the overall property income situation. And more importantly, for unit holders or investors, you care more about the dividends, because at the end of the day, that's what goes into the bank. You hold a REIT for the dividends. And that's also not good news for you, because the distribution per unit dropped by 11.6% in the second quarter for their FY. And even if you exclude the property tax refund, which was one-off for VivoCity, it would still be down by 9.6%. So it is something that nobody likes. Who likes pay cut, right? Who likes dividends to be lower? And therefore, I think that is one of the key reasons why MPACT shares were sold down today. As of the time of recording, the market is still live, right? So we don't know what price will we end by the end of today. And I just wanted to shed some views on this property portfolio of MPACT. Okay, I have always been more concerned about that, because MPACT was previously two separate entities. One was a Mapletree Commercial Trust, and the other one was the North Asia Commercial Trust. And they merged together a few years ago to form this MPACT. So the MCT, or the Maple Commercial Trust, mainly hold the Singapore properties, which is VivoCity, Mapletree Business Center, or Business City. And the other one, the North Asia one, will hold all the overseas one, right, in Northern Asia, as the name suggests. When they merge together, I always feel that it's less attractive portfolio, because Singapore properties are still preferred, right? They always have that premium. They are more stable. Based on my years of experience and observation, a lot of properties overseas will suffer certain cyclical period, right? Not saying that Singapore doesn't have, but Singapore property market is really a lot more resilient. Retain value, property value a lot better, if not appreciate over time. And a lot of other property markets overseas, we see issues, right? We see China, Hong Kong have their property crisis. We see that the US commercial properties also have their issues. it seems like nobody else is really immune to this property cycle, and just that Singapore property market weather these periods better. Okay, so I will always see that the Singapore property is worth the premium, and REITs with a bigger representation of Singapore property is also preferred in my own view, right? So if we look at this MPACT property portfolio, it's not that bad because at least 60% of the properties are still in Singapore, but the remaining are in overseas. Okay, and if we look at the occupancy rate, we can see the Singapore occupancy rate is above 90%, right? Some other properties overseas also above 90%, but you can start to see some issues, right? Like the China properties at 87% occupancy rate, and the Japan properties are worse at 82.3%. So this is what I mean that from time to time, you will have these issues with overseas property, right? Occupancy rate, demand will fall, and that will then impact the rental as well as the REIT prices. And something that's even more concerning, look at the rental reversion. And if we see the Singapore properties are the one with positive rental reversion. If you look at the rest of the overseas property, they all have negative rental reversion. Festival Walk is down 6.1%, China property is down 2.9%, Japan is down 9.5%, and Korea is down 27.3%. Okay, so it is again the Singapore properties that are resilient, but the overseas properties are giving a lot of issues, and which means that even when their occupancy rate is high, right, more than 90%, it is because the rental rates have been reducing in order to entice tenants to stay or new tenants to come in to take the space, right? Nothing wrong about that, but I'm just saying that it's less resilient as we can see from here when it comes to overseas property. So I don't like that uncertainty when certain overseas property segment will run into issues. Okay, so I always prefer to look at REITs with majority Singapore properties. And the problem right now that MPACT is facing is in particularly these Japanese properties in Makuhari, and that these three buildings accounted for about 5.4% of MPACT's net property income. And the biggest problem is the single tenant Fujitsu, who don't want to renew the lease when it expires at 31st March 2026. So there's still a good 2 years to go. But these are information that the stock has already priced in. So that means that MPACT would need to find more tenants, maybe smaller tenants, to take up the entire building. There's a lot of work to be done in this aspect. And it's not limited to MPACT. When I look at some of the developments in other REITs, what kind of properties they're buying, is again concerning for me. And this is a trend that I think REIT investor should pay attention to. Anytime that a REIT start to buy overseas properties, there is a chance that the overall property portfolio become less attractive. As I mentioned just now, Singapore property do command a premium, and they do perform well and are a lot more resilient. So for example, Parkway Life REIT also recently announced a first acquisition in Europe, that is in France, buying a bunch of nursing homes over there. Yes, I get the story, aging population, blah, 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 right? I buy the story, but again, we don't know how resilient these properties are eventually, right? So for Parkway Life REIT, they have also been expanding in Japan, nursing home, again, another aged population, right? Again, I can understand the strategic imperative, but I just, at the end of the day, still feel uncomfortable, right? The core property of Parkway Life REIT is the private hospitals like Mount E, Glen Eagles. Tenants will always be there. They won't move because healthcare is a very critical part of our society, right? And you don't move hospitals around, otherwise your ambulance route will be all over the place, and there's not much room for it to move as well with all the equipment, etc., etc. So these hospital property are very prized assets, right, in Singapore. Okay, but when you mix with more and more nursing home, I would feel that the prestige would naturally go down. And now you're expanding to more areas. Beside Japan, there's now France, and next we don't know what it is. Yes, maybe you can argue that the advantage is diversification, but I just see it from the other side of the angle. It is more like diluting the current quality of the portfolio and increasing risk, because that means that if the property cycle in certain segments suffer, that may impact the overall property portfolio in Parkway Life REIT. Just like what we have seen in MPACT. Initially, it was Festival Walk. Then now we have the Japan properties. So from time to time, there's this heart attack, which I think That's not what investors want. Especially if you want to buy and hold a dividend producing stock, you want to have that peace of mind when you hold them long term and not have that kind of shock from period to period. And this is also the third example is a Capital DC REIT and data center focus. Okay, they have also been buying overseas properties. Okay, and they also have their fair share of headache. One is the Guangdong data center, giving some issues with the tenant running into financial problems. So I could also understand that why Capital DC is doing this, because Singapore just don't have enough data centers for you to buy, and they're forced to go overseas. And maybe data center is less sensitive to economic cycle, right? Because it's still in the growth phase. We're going to a digital economy. We're going to need more of these data centers, and maybe, right? For all we know, that they are safer to expand overseas, okay, but it remains to be seen, right? We also saw that the China data center property also ran into issues, okay? So I do hope that data center is probably a different league, so only time will tell. And this is the same for Mapletree Industrial Trust, MIT. They also went into data centers a few years ago. They bought into the US data centers, and it actually increases the exposure to US by up to about 55% of the entire property portfolio. Previously, it was just Singapore-centric, right? Now, it is heavy in US, and also recently they expanded into Japan, and they want to buy one more, right? Then the Japan exposure will increase to more than 5%, probably about 6%-ish. Thereabout. So again, we can see that a lot of these local REITs are buying properties overseas. And I told you my reservation, and I think it is not an issue now, right? I believe that the management has done their job to really assess the properties well and make sure that it's really a good deal, yield accretive for investors. But that is now, right? We don't know in the future what kind of hiccups will happen in these different areas of properties around the globe. And therefore, I would be a bit more cautious, right? If the acquisition of these overseas properties start to be more and more aggressive, I would really reassess what I would define as a good REIT or not. So I think this is really a watch area for REIT investor. Do take note of all these overseas acquisition and do monitor their performance from time to time. I hope this video has been useful to you. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one.